Can you hear that? It's the whisper of closing account. At the end of the accounting period, after the adjusting entries have been posted, accounts gather in silence. They say if you don't do it properly, your balance sheet might never rest in peace. Let me tell you a story about two types of accounts. Some live forever. These are called permanent accounts, assets, liabilities, and equity. But others, they vanish into the void. We call them temporary accounts. Revenues, expenses, and owner's drawings. At the end of the accounting period, we must perform the ritual. We must close these accounts, zero them out, or else they'll haunt next period's books. Step into the ledger with me. We trap the revenues. They go straight to a chamber called income summary. Debit revenues and credit income summary. Then the expenses. Drag them screaming into the same chamber. Debit income summary and credit the expenses. The income summary at the end release its final breath into capital. And finally, the owner's drawings, we cut them off, feeding them to capital. But the story doesn't end there. Once the accounts are closed, a new structure must rise. The classified balance sheet is built, like a crypt with everything in its proper place. It holds three main sections: assets, liabilities, and owner's equity. But within each tomb, order must be kept. Let's open the first. Assets are divided into 6 main categories. Some of them are the living and the others are the long gone. Current assets, these are the living. Cash, short-term investments, accounts receivable, inventories, supplies, prepaid rent or insurance, all used within 1 year. But beneath that layer lie the long-term assets, long-term investments of more than 1 year. Non-current assets, like financial investments, not used building, and long-term notes receivable. Property, plant, equipment. These are tangible long-term assets, usually depreciate. Equipment, vehicles, buildings, machinery, land, and accumulated depreciation accounts. Be careful. Lands do not depreciate. Intangibles like patent, trademark, copyright, natural resources, licenses, and goodwill. They sit still, watching, waiting. Next come to liabilities, including current liabilities and long-term liabilities. Current liabilities within 1 year, like accounts payable, interest payable, insurance payable, or salaries payable. Any accounts payable and unearned revenues. The long-term liabilities. These are beyond 1 year, like haunted promises, mortgages, bonds. They linger for years, but be careful. One portion of mortgages, loans, and interest might be due next year. These are considered current liabilities. They should be calculated and extracted from the long-term liabilities each year. This is the formula to calculate interest payable for the next year. This portion of interest payable is a current liability, not long-term one. Finally, owner's equity, the spirit of the company itself. It grows each time we close the books, each time income survives the ritual, and it isn't paid out as owner's drawings. This was your guide through the shadows of accounting. Now you know how to close the accounts and build the classified balance sheet. Just remember, never fear the ledger unless still open after an accounting period. And also remember, put items in order in balance sheet.